Hey, how's it going, everybody? And welcome back to another video of Income Views, another podcast episode. If you're new, remember to leave a like, subscribe, and hit the notification bell for more. This one, again, is going to be all about Schd as well as Jepq, because we're going to be doing a side-by-side comparison, really getting in depth, really trying to decipher whether or not the better buy is Schd versus Jepq. The first thing I will say for certain, of course, is always take a look at the certain market conditions. Which I literally just did a video with, kind of dissecting what Carmen Rosado is going through with certain market conditions changing since around Christmas time and having a massive correction to the market. And that's always something you really need to take a look at and really try to get your head around if you can, and try to really adapt and understand the certain market conditions that you're in if you're any sort of investor, whether you're a long-term holder or if you're a day trader, so on and so forth, especially, by the way, if you're a day trader, for the love of God. They got to be on top of it. So Schd versus Jepq. So Schd, over the past month, it's really since November 29th at least, for Schd, there has been a really significant decline, which also could be a buying opportunity. It has bounced back since January 10th and has gone up to 27.83, but it did lose some value, of course, at a peak, or at least from November, at $29.53, at least according to Google. Now, if you're going to take a look at Jepq, of course, this is just the values in and of itself. Just trying to take a look at that, and then we'll bounce to something else here, which is even more important. And of course, at JP Morgan NASDAQ Equity Premium Income ETF, then we're going to take a look. And really, there has been a bit of a pullback since around where Carmen Rosado actually, didn't recognize certain market conditions. Of course, he's a day trader, by the way, on YouTube, with about 160,000 subscribers. But I'm using him as an example because he lost a lot of money in the stock market very, very recently. And it was really interesting to kind of take note of that when I was kind of, doing a video about him. So let's take a look, though, and kind of just dissect this, piece by piece. Schd is a focused U.S. large cap dividend paying stocks with a track record of consistent and growing dividends. It tracks the Dow Jones U.S. Dividend 100 Index, where Jepq is an equity income ETF with a covered call strategy, where it invests in a portfolio of large cap U.S. growth stocks and then sells call options on those stocks to generate additional income. So they're very different. The strategy, known as a covered call strategy, aims to produce enhanced income through premiums collected from selling the call options while still benefiting from stock price appreciation up to a point. So the ETF is designed for income investors looking for an additional yield, but it may limit upside potential because of the call options capping returns. Dividend yield and income generation. This is key. Schd typically has a dividend yield in the range of 3 to 4%. The dividend payments are usually quarterly, and the fund prioritizes companies that have a strong history of paying and growing dividends over time. We talk so much about Schd and that incredible dividend that it offers. However, Jepq has a higher yield than Schd, often in the 6 to 8% range, due to a covered call strategy. This strategy allows Jepq to generate additional income from premiums received from writing calls, which boosts the total yield. However, the trade-off is that the strategy limits potential upside in the stock price because the sold call option caps the gains above the strike price of the options. Now, risk and volatility. Schd is generally considered a lower risk dividend ETF because it focuses on high quality established companies with stable cash flows the dividend-focused strategy can be more resilient in volatile markets. Really, especially, by the way, in 2022, where I've taken a look a bazillion times at SCHD, and we've talked about this a zillion times on the channel, where SCHD can be resilient. At least that's what it's shown in the past, at least in 2022 alone in and of itself. It didn't fare well in 2020. However, I mean, nobody did really, for the most part. But, however, it did extremely well in 2022, which is really an interesting, an interesting thing in terms of SCHD. If you were an investor in SCHD in 2022, you were doing all right. JEPQ can be riskier in the sense that the covered call strategy introduces some additional complexities, while the strategy can provide downside protection through premiums collected from the options. It can also limit potential gains in rising markets. The underlying portfolio of growth stocks could outperform the covered call strategy in strong bull markets, which means JEPQ's upside is capped. However, the income from the options can help cushion volatility, especially in flat or sideways markets. Performance potential. SCHD's performance is largely driven by the price appreciation of its high-quality dividend-growing holdings. Its historically delivered competitive total returns is relative to other dividend-focused ETFs in the broader market, as it says here in my notes. And of course, JEPQ, on the flip side, JEPQ's total return potential is impacted by its covered call strategy. That's the difference between these two ETFs. Okay, SCHD relies on the performance rather than JEPQ's total return. Again, potential is impacted by its covered call strategy. The call options limit upside in strong bull markets, but the premiums collected from selling calls provide steady income in flat or range bound markets over the long term. This can result in lower overall growth compared to ETFs like SCHD that are purely focused on capital appreciation and dividend growth. However, in sideways and volatile markets, JEPQ could potentially outperform SCHD in terms of total yield because of the options premiums. So, in summary, of course, SCHD for some people could be a better option for investors looking for long-term capital appreciation and steady dividend growth with a low risk, cost-effective strategy, of course. Now, JEPQ is a good choice for investors seeking higher income, 6 to 8% yield, and willing to accept some trade-offs in terms of limited upside potential due to the covered call strategy. So your choice depends on whether you prioritize yield or balance of growth and dividend income for SCHD. So if you like this, remember, leave a like, subscribe, and hit the notification bell for more. Thank you so much for watching, and I'll see you in the next one.